All right, so Jim Zaspel, I appreciate you taking time from your busy schedule and talking to us today.
Stoked to be here. Appreciate the opportunity to help you out, to be here, and all that you guys do for us.
Yeah, man. Well, look, I think coming out of 2025, it was a turbulent year for some.
Yes.
Tell us how your business was affected, either positively or negatively.
Yeah, it was a challenging year. We did 88 deals last year, which is a step down from the year before, and a step down from the year before, and the year before that, right? But 88 deals. I think 42 of those are fix and flips, like 15 or 16 wholesales. Bought some rentals and sold some rentals as well, right?
Okay.
But last year it was interesting. I feel like we've got a sense of like where things are now, but it's always. We always make the mistake of trying to time the market a little bit sometimes, right? And like, how aggressive can you be with values? Because when we're underwriting deals, you don't want to lose money for the sake of being too conservative. You don't want to, being too aggressive rather. You don't want to miss out on deals for the sake of being too conservative.
Sure.
Right. And so finding that balance was hard last year. So, what I discovered was, this is like my number one takeaway from the flips. Like, I lost money on a handful of flips last year. Like, I shouldn't say this out loud. Maybe we can edit this. I don't know. But like $387,000 in losses on deals if you sum up all the ones I took L's on. Yeah.
And just so everybody knows, is that they took too long? Was it you didn't get your right out sale? Mm-hmm. What happened that made
so there's a mixture of them, and that's what we get into here. So I think the number one takeaway from me of this is a $387,000 lesson right here, right? Is buyers are picky.
Yeah.
Buyers are plentiful. Buyers are picky. And like these flips, they're all in the suburbs, right? Great areas. But I used to have, for instance, what I called a 3-strike rule. If there were 3 things wrong with the house, I wouldn't buy it. A strike being no basement, small bedrooms, low ceilings, no garage, busy road, crappy neighbor, whatever, right? Mm-hmm. Now, if there's 1 strike, I'm probably not buying that deal. Or if I am, I got to be able to sell it at 15% discount and still make a bunch of money, right?
Wow.
So I learned that lesson the hard way on a bunch of houses last year, right? So, but conversely, if I look back, at the ones that did well, they were just normal freaking houses in great neighborhoods with no strikes, and they sold great every single time, right?
Yeah.
But there's one, because think about it, if you're going to, fork out a bunch of money for a down payment, right, and you're going to pay these crazy interest rates, I'm talking about retail buyers now,
right?
And pay about a big monthly payment, you got to make sure the house checks all the boxes to feel good about it.
Yeah, and they can afford to be picky right now.
Yes,
right.
There's a little bit more inventory.
Yeah,
prices are not down. Prices are up year over year, a little bit.
Yeah,
but they got to be the right kind of house.
That's right.
Yeah. Okay. So that's my number one lesson, $387,000 lesson.
Yeah. So what does 2026 look like? You think you're going to do more? Are you going to switch products? And this can get into some of the lending too. Like, are you going to utilize more of the fix and flip, fix to rent, the DSCR, construction?
So my goal this year is, I don't care if it's like 3 or 4 or if it's 10. I hope it's more like 10, but I want to add at least 5 or 10 rentals to my portfolio this year in the suburbs. I made the mistake before of only buying deals where I could leave no money in the deal, or like less than 10 grand, right?
Yeah.
And so, when you factor in your debt service coverage ratio, the numbers have to pencil a certain way. What does that mean?
Right.
It means you're focusing on lower price point areas, right?
Okay.
And that was a mistake because you got to ask yourself, like, why are you buying rental properties?
Why are you buying them? What are you looking for?
You're not buying, if you're buying for $300 a month cash flow, that's stupid. Stop, find a new reason, right?
Right.
The reason I buy them, and I finally realized this after buying 98 houses in Philly that I shouldn't have bought, rentals, right? At one point, it was like 98 rentals in Philly.
Yeah.
I'm down to like 45 or 50 now.
Yeah.
But it's like, I don't want to own these houses. The reason I buy them is the better areas appreciate more, right? The tenants are easier. Like, I literally have rental properties I forget about. Right, and those are the nicest houses.
Those are the best ones. You don't hear no tenant complaints, right?
Yeah. So I buy this, like, what do I want? I want to have an easy asset to manage. Mm-hmm. I want to have properties that go up in value.
Yep.
Maybe they don't cash flow a ton. Maybe my cash on cash return for the 30 or 40 grand I got tied up in that deal after the refinance is only 10 or 12%.
Yeah.
Well, if your cash on cash return on the money you got buried in the deal after you do your DSCR loan is 30 or 40 grand, you get 10 or 12% on that, your IRR is probably more like 20 or 25. Right. And if you're watching this video, don't know what that is, like, Google those terms, because like, you got to learn that stuff. It's pretty important. Yeah. But where I got stuck on before was, I want 10 grand or less buried in the deal, and I want at least a 15% cash on cash return.
Right.
That meant I did deals in the hood, and some people have an appetite for that, and like, God bless you, that's wonderful.
Right.
And like, there is a business model for that. It just doesn't suit me.
Yeah, and you got to make sure you have the right infrastructure in place. Like, if you're going to do that model, you got to go both feet in, right, and do it well. Like,
Yes.
you can't. I would say like not dip your toe in there and then do some higher end stuff, right? Like you got to have the team built out to do that successfully.
Yeah, 100%.
Talk to me about. So obviously you're doing a lot of rentals. We originated a bunch of DSCR loans for you this past year.
Yes.
Now that rates they seem to be in this downward trending direction, right?
Yeah.
We've also talked about, I'm sure you have some rates in the 7s and 8s that you're now thinking about refinancing. Run me through your thought process of like, okay, a rate reaches a certain level. It makes sense for me to refi this now. And then I'm going to pay X origination points to get to a certain rate. Like, what should people be thinking about?
Yeah, so I'm glad you asked that question because I see like a lot of ambiguous answers about this, ambiguous thoughts. People don't actually have a lot of, I'll say, like intentionality behind it, right? It's like, oh, that's too much origination. It's like, what is too much, right? How much do you want to spend on a house? Depends on how much you can get out of it, right? So here's my simple math formula I go through, right? It's very simple. And again, it comes back to this cash on cash return, right? So you and I were actually corresponding this week about a property and a refinance out in Pottstown. So 2-unit property. I have a 7.45% interest rate on the 30-year loan right now. I'm not, because of the time sensitivity of things, I'm not going to go through the exact percentages, but it makes sense to come down on this. And the way I did the math is took my annual principal and interest savings. Not PITI, principal and interest savings, the savings per month times 12. Annual P&I savings divided by the cost to do the deal. That's
so to pause right there. That's the old mortgage at 7.5 versus the new mortgage at call it 6.5, 675, whatever that is, 6375. That's the difference in that monthly payment.
Yeah, so it's called $278 a month difference in savings times 12, whatever that number is. Divide that annual savings by the total cost to do the rate and term refi, which is what we were talking about in this case. So that's origination, title, other fees, whatnot. And if that number reaches a certain percentage point, and also depending on where you think rates are going, then pull the trigger. Like for somebody who's watching this video, it's like, what is your cash on cash return? Like, are you got a few $100,000 stocked away in a 5%, savings account? Okay, how would you like to get 15%? Right. That's kind of the math. And I do the same thing when I not just refinancing, but when I'm always asking you, how far down can I buy the loan?
The rate you always do.
And then you or somebody says, well, how far do you want to go? It's like, I don't know. It depends on the day. Give me tell me for every point, where's every additional point of origination? Where does I put the loan? I do the same math formula, and sometimes I do 4 points. Sometimes I do like the minimum.
Right. I think the message is sometimes there's just like obviously no one wants to pay points, right? No one wants to pay money to like borrow money, but there's actually a formula that you should look at, right? It's that monthly savings versus the old rate, new rate, and then how are you amortizing the closing cost, and what like return period is that, right? At what point do you make that money back? And look, if this is a 30-year loan and it only takes you 12 to 24 months to amortize until you get that cost savings, I mean, it could make a lot of sense, right?
I honestly, if you get 20% cash on cash return, like that's 5 years, and like, I don't know about where you got your money part, but like my money ain't earning 20%, right? So
no, I wish.
That's why I'm okay doing that.
Yeah. Agreed.
Yeah.
All right, shifting gears a little bit. So we met, it's got to be like 7 years ago at this point,
I think it was 2016 or 17.
Yeah.
Little meetup groups I used to do. Well, they were still little, but yeah.
It was big. I think it was in like KOP, and you were one of the speakers. I came up to you after, and I was like, hey, man.
Is that where we met?
Yeah.
Okay.
Yeah, it was one of those. I gotcha.
That's funny.
Yeah.
That's funny.
Yeah, it was good, man. Well, you had a lot of good stuff to say back then, and I'm glad that we did meet. So now that, I know you use other lenders too, I guess I would ask you, what is the most important thing to you when working with a lender? Besides rate and points, obviously.
So terms absolutely matter. I'm going to say there are two things that are most important. One, and this is true across the board, I don't care if you're a title company or a lender or a contractor. I only work with people who want my business. There you go. Right?
Yeah.
And I'll say this, like I've got one or two other great lenders to work with, but I don't think anybody from you on down has the mindset, comes across in a way that you want to earn my business as much. Right. And I think you guys, nobody will work harder to want your guys' business. You've made it like really clear. It's like, hey, Jim, we want to do more loans.
Appreciate that.
And you guys don't just say you want more business. Who doesn't want more business, right? But you guys back it up with customer service. And I'll say this. So I had a experience yesterday. with a different vendor. Wasn't a lender, just a different vendor.
Yeah.
And I characterized somebody's work as half-assed. And that person's boss like fired me as a client. Right.
Wow.
Like it was a title company. Did 60 transactions with them last year.
Yeah.
It was a brand new relationship. 60 transactions, 60 something inside of 12 months. And
Not to name
they fired
names,
me
I'm sure I
because
know.
they fired me because I referred to somebody's efforts as half-assed.
Yeah.
And like that's just somebody. It's like people are trying to mend the relationship. Like, you know what? It.
Yep.
Like if you don't want, you can edit out the F word. My dad
Keep
might
it.
watch this. My dad might watch this. Grandma might watch this. We don't want that in there.
Keep it.
So it's like, my point is like, if you don't want my business that bad, screw you. There's
Right.
other people out there, right?
That's great.
And I've probably said a lot worse things than half-assed to you.
Yeah.
And like you handle professionally. If you got to straighten me out and say, Jim, like I hear you, but here's the reality.
Yeah.
You'll do that, but you guys are always respectful, and you guys kind of like you absorb the
Absorb it.
Absorb it. A little
Also,
bit.
one thing I respect about you, I want to be called on our shit. If there's something that's going on that's inefficient or wrong, I like that. I'd rather have you tell me rather than internalize it, never bring it up, and go to another lender. That's one thing you do extremely well. And if you
think I bitch and complain really well?
No, yeah, sure. But no, in the same breath, you also, I think it's fair. And if you realize that it's actually something on your end, you're like, hey, my bad, I take ownership of that. It's very much a two-way street.
It's
yeah,
gotta be. I think it's called mutual respect, right?
Yeah.
It's like when I hire people, I always say, hey, listen, there are going to be times when I offend you or you get offended.
Right.
As long as the atmosphere is one of respect, nobody, including me, is above reproach. And
Yeah.
that's the way all healthy relationships work.
For sure.
Yeah.
Mutual respect. So there's another point too. So I want to make sure I touch on the fact like what lenders look for in a good relationship, and something you do extremely well is like being organized and being on top of stuff. I can't tell you how often it's like, well, how quickly can you close? And I'm not just going to give a range. It's like how I'll close as quickly as you allow me to, right? Like if we ask for documents, I think you set up your team very well where you're not just the guy like in the weeds and like finding deals, you're helping with documents, but you have a team and everybody knows their role.
Yes.
Right. And like that helps our teams communicate effectively.
Yeah.
So I think that's something you do really well. And I think when lenders are looking for a relationship with a customer, I think that's something important for everybody to hear. Like that's what a lender wants to see, what you have set up.
I think there's a lot of a big lack of what's the word I'm looking for? Like being honest with oneself on the terms of borrowers, right? Before you say a lender sucks, like let's just diagnose that a little bit, right? What was your response time? How long did you send over all of your supporting? If you're doing a DSCR,
Right.
Did you send over all of your leases, your entity docs, your bank statements, all this kind of stuff, like with the loan submission?
Yeah.
Like, no, then like maybe you suck.
I love it. I love it.
So I think it's important, and I think it's just important to be honest with yourself. Like, hey, am I holding this up or not? There was a situation recently where I forget who it was your team. I asked I basically said, this is absolutely this hasn't closed yet. And then someone on your team politely said, forward me an email that was sent like 9 days prior.
Yeah.
Hey Jim, if you happen to send this, we missed it. Sorry. I was like, oh crap.
Yeah.
Sorry, we didn't actually send it. Sorry. Yeah.
That's what I mean, but it's mutual respect.
Yeah.
We're going to up at some point and likewise, right?
Yeah,
Being human.
I think it's important, it's how those things are handled, right? So whether it's a mistake on iFund's side, which is rare, but whether it's a deal-specific hiccup, market change, whatever, it's how we handle communication.
Yes.
Those challenges, which I always appreciate how you guys do that.
Yeah, we try to set expectations well, right? The conversation's way easier if something changes or something happens when we went into it eyes wide open, right?
Yeah, there have been some challenges like the last, I'll say like 3 or 4 years, like rates, like the capital markets,
I know.
like as you know.
I know. For us, it's less about like, yes, everybody wants rates to go down, but I think just rates stabilizing, even if they don't get as low as people want, if we could just string together a couple years of normalcy where it's not like whiplash every quarter, right? I think that's what will stabilize the market a little bit.
I think so, but I also think it's like the approach you take to it, right? So, if 25 basis points makes or breaks your deal,
Don't
buying
do
the
it.
wrong house.
Don't do it.
Yeah, don't do the deal.
Don't do it.
Right?
That's right.
And it's like, I don't know. Yeah, it's like what are you in this for? Like if all of a sudden you can't afford it, you can't come up with the down money, you can't float a $10,000 difference with the appraisal, like just take a breath, wholesale that house, then keep the next one.
Yeah.
Right? Have a little bit of
100%.
reserve. That's one mistake I made. So in 2022, I bought 50 rental properties in the first 6 months of the year.
Yeah.
And also scaled my flipping business from 8 employees to 25 in a 2-month span, right? So it was like way too much. I totally underestimated how much cash it was going to take. And that's the point I'm trying to drive home is like, rental properties I'm a big fan of, but I think it's important to not underestimate how much cash that can take.
Yeah, for sure. Any interest in like the new, have you done new construction before? Any interest in doing it? If not?
I've built like three houses.
Okay,
2 or 3. We're wrapping up one right now in Yardley.
Okay.
Borough,
Nice.
like 2 blocks from the river. It's pretty nice. I'm very excited about that.
Very cool.
So interest in it? Yeah, maybe. But like I was talking to a buddy of mine, Greg. He's building one in Westchester next to a house I just flipped.
Yeah.
And he said, yeah, my cost to build is like $145 a square foot.
Square foot, yeah.
I'm like, well, that's not my cost. So like, I can't compete in new construction.
Yeah.
Right?
What are your costs?
I mean,
slightly higher.
It would be like twice that almost.
Twice
for
that.
Nice, so for like a really nice high end. It might be low 2s. Right?
Yeah.
I guess it's more like low 240s, 230, 240 square foot.
Yeah, it's tough. How do you make money?
There's no way for me to make money doing that.
Yeah.
Right? It's just I'm not set up for that. I use, it's like there's 3 models for construction. So model 1 is you have in-house workers do everything but the trade. Like your W-2 employees are swinging hammers, and you're sourcing materials and sourcing materials for your subs. You just pay your subs for the trades, the mechanicals, etc. Because again, that's one model. Next model is maybe you source all of the subs yourself, and you have like one contractor or GC who just does like fit and finish and that kind of stuff, right? And the third model that I use is I hire a general contractor who does basically everything, not quite. So we hire directly a GC, septic guys, driveway guys, and landscapers and cleaners, and like I think that's it. Sometimes the concrete guy, right? But he sources and coordinates everything else. So yeah, it's a lot more expensive for me to do what somebody else might do, but it's also more scalable. I have a pretty good work-life balance, right? So it's like trade-offs, and we make the numbers work. Except for 387,000 times last year. We make the numbers work on most of the deals, right?
Yeah.
And but they're not set up for new construction. It's just not efficient enough.
Yeah. It's 387 lessons learned.
Yes.
Right?
Yes.
Yeah.
Yes.
There you go.
So what do we see in this coming year in 2026?
Yep.
We're already in 2026, but I think it's going to be a little bit better than last year. And maybe I say that because I'm an eternal optimist, right? But I think there's reason to believe that, right? For me, personally, it's going to be better than last year because I've learned a lesson. The big lesson I learned, as I mentioned earlier, was there can't be anything wrong with the house. No unfixable issues with the house. It's got to be a normal house. I'm definitely more conservative with my underwriting, right? It's not gone are the days of like, hey, what's the highest comp? Great, add 5%, man, we're going to crush it. Like, no, like I actually need 2 or 3 comps.
Right.
Like, go figure, it's back to basics, right? So I think if we stick to the basics, I think it's kind of hard. We're not going to experience the whiplash. Like I mentioned, those 50 rentals I bought a few years ago.
Right.
In the first half of 2022, we all remember the last half of 2022 did. Like that's when I was getting all my loans. It sucked.
Yep.
I don't think we're going to have 50 and 100% increase in interest rates this year. So I think that
I don't think so either.
I think it's pretty stable. I think buyer demand is there. I don't think if you're buying based on appreciation, I think you're crazy. I think we've used up the better part of 10 years of appreciation in the last 3.
Yep.
I think rates are going to, not interest rates, but like values are going to stay relatively flat for the next several years, and some markets go down a lot. That's what I think.
Got it.
Just because it's unsustainable. You look up at the affordability rate. I don't think that values can go higher. Nobody can buy a freaking house.
Right. Yeah. And just so like people in the area, what products exactly, or like types of housing are you going to be focusing on in 2026? Like value and like single family versus quad, stuff like that.
Sure. So there's one phrase that I think has been true for 3 or 4 years. I've said it like a million times, and that is affordability is the key to success.
Yep.
Affordability is the key to success. Now, what is affordable? It's extremely relative, right? So you and I looked at a house in Wayne. You guys funded it, right?
Yep.
Listed for 2.5, sold for 2.6. I'd never done a house.
Not affordable.
But it is. This is my point. For that neighborhood, it was below the average.
That's right.
It was below the average, right?
That's
There are
right.
$8 and $10 million houses. It was very affordable.
That's right. That's right. Sold in like 10 days.
Yes. We had 2 cash offers, one at 2.55, one at 2.6.
Great job.
Yeah, thanks. It was that was a long project. But it was good. So I think affordability is the key to success. I think that values are not going to go up. I think their values are pretty stable. I don't think we have any reason to believe that interest rates are going to go crazy high this year. That's just my opinion. I'm not the smartest guy in the world, but that's my opinion. What am I focused on? I'll do any deal, but the higher the price point, the more cautious I'm going to be.
Sure.
Right. So another thing that we're doing a good deal of is we'll buy a house, and if it's livable and financeable and not offensive, like it doesn't stink, it's not filthy, clean it out, put it in the market, see what happens.
Yeah.
So most every house I buy, even if I'm using bridge loans, like hard money, every house I buy it, clean it out, and sell it. Sometimes investors buy this one in Hatfield. How long? I don't know how long till this airs. Hopefully it's not for like a week or two. But I bought it for $275. I met my contractor at the place, and I just need a little bit more work than I realized from the pictures. And we decided like do a dormer here, bump out, and the construction budget came in pretty high, and I wasn't super confident on the out sale. Was it worth it or not? It's like, you know what, Mike, my contractor was like, I'm going to list it and see what happens.
Really?
So I sold it for $360.
Wow.
Yeah, like didn't do anything to it.
Wow.
Yeah. So that's like it
amazing.
happens sometimes. Yeah. And some people say, well, Jim, but you paid the origination. Who cares? Like I made as much in 3 weeks as I would have made in like 5 or 6 months.
Or even if you didn't make as much as in 6 months, but you were in and out in 3 weeks, there's something there too, right?
100%.
Easier dollars.
Getting your money back, and like I think for me, the fewer risks I can, potential downsides I can eliminate.
Yeah.
The more of those I can eliminate, the better. Right.
Got it.
So what am I focused on for this year? Affordable, and easier rehabs are better.
Yep.
And I'm just a lot less optimistic on a deal specific basis.
That's good.
And I think you got to be. It's what's going to keep me from
keep you honest.
Keep me honest.
Yeah.
Yeah. So that's one thing.
Awesome. So last question. We'll wrap up with this. The person who is on their first flip or second flip, how do they get to 100 or more plus?
How do you go? How to go from 1 to 100?
Yep.
So going from 1 to 10 is harder than from going to 10 to 100.
Okay.
Right? So I think like getting your first one, getting your first few is important. So I would say like the most important thing. Like my career has been set back a few times by like huge mistakes I made.
Yeah.
Right? When I tend to make a mistake, I make them pretty big.
Yeah.
Right? It's just it's my nature. It's okay. Yeah. But like so how can you avoid some of the mistakes? I think at the beginning. I don't want to say this to make people too gun shy, but at the beginning, I think it is kind of important to avoid mistakes that like have the real potential to set you back. So how can you do that? So stick with the basics. What are the basics? A house that's normal for its neighborhood.
Yeah.
Like, don't buy the biggest house.
Right.
If your house is 30% bigger than any house in the neighborhood, it is not worth more than the already most expensive house in the neighborhood.
That's great
Just
advice.
Period, right? So
great advice.
your house is going to be normal for the neighborhood. Stay away from busy roads. Low ceilings suck. Small bedrooms, buyers don't like them.
Yep.
If your house if the subject property doesn't have a basement,
Yep.
Then none of the comps better have a basement either.
Yep.
Right? If the comps have a basement, yours doesn't, take 15% off the ARV.
Yep.
Like 10 or 15%. 2 years ago, it would have said 5%.
Right.
But take 10 or 15% off. Right.
Yep.
Just walk. Like it's so easy because the inventory is a little tight right now. It's weird. Like shit's expensive, but like inventory is also tight. Like it's just a weird market, right? But when deals are hard to come by, what I find is like these rose-colored glasses that investors get. Looking at houses, don't do that. Be objective, right?
Yep.
So I think avoid some of the mistakes. Make sure you're buying a good house.
How about scalability? How about like building out a team and like raising capital, having a good architect, contractor, lender? Like, how do you build that stuff together?
Yeah, so some of the mistakes I've made is trying to scale with bad operators or bad team members. I don't say bad that they're good people. I liked them, but they just weren't qualified. Didn't have the skill set, right? So I'm a big fan, and you mentioned this earlier, of having narrowly defined roles, right? And so having people what they're good at. And I remember one time, this was probably 8 years ago, my wife, she used to be a little bit more involved in the business, but she said, I can't believe so-and-so did whatever or failed to do something. It was like common sense, plain as day, should have been done.
Sure.
And I told her, my wife's name is Marina. I said, Marina, that wasn't in writing. Like, we didn't actually tell her to do that. It wasn't the job description. It wasn't on the checklist, whatever it was.
Right.
I said, you're right. And like anybody who had an IQ above 70 would have thought to do that. But we didn't have it, so we got to hold ourselves. So we can blame him all we want.
Sure.
But if it's not in writing, we can't expect it, right? So narrowly defined roles, make sure people are clear on it, and have 2 to 5 metrics that each team member can objectively look back and say, I'm succeeding in my role or I'm not, right?
Yeah.
Great book for that. There's 2, like Traction is a good book,
Traction's
or
great, yep.
4DX, 4 Disciplines of Execution. You do one or the other, right? But they're both great books, and I think having leading indicators is a big 4DX thing. Leading indicators of what does success look like in that role, and having the 90-day targets is very important, right? In terms of scalability, in terms of capital, you'll learn what your lender wants. Learn, like, what does iFund look? How do you guys operate, right?
Right.
What are you guys looking for in a deal, right?
Yep.
Really learn. Like when I started buying rentals for the second time in 2019, that's what I did. I went to you guys and other folks.
Yep.
How do you underwrite a DSCR loan? Like I'd never heard of this stuff before, right?
And so you're underwriting to a lender almost box, not just yours, right? Also a lender box. Yeah. Okay. Yeah.
And then, like, be honest with yourself. Like, okay, so your lender does 80% loan to cost, or 70 or 90, whatever it is. Like, well, that's your upfront money. What about your draw reimbursement money? And what about the what if?
Sure.
If you don't have an extra 10 grand or 10 grand available to you for like an oops on the deal as it goes on, because they happen, right?
Yeah.
I think it's, you ask yourself those questions. Have that money lined up, right? Maybe it's a buddy who's going to lend you some money.
Yep.
Make sure you're compliant in how you do that. But I think it's important to be honest, because what you don't want to do is find yourself halfway through a project and like, well, I can't afford my next draw.
That's right. Yeah.
I'll tell you one thing that's important is the draw reimbursement spreadsheet you guys have. I like it. But what some investors do, they try to make it really front end heavy. I think that you guys do a very good job of seeing through that.
Sure.
And so I think that when you create say you got a $120,000 renovation budget, right?
Yeah.
Don't tell me the demo costs 30 grand, but like if it costs put $8,000 in there, right? I've got myself in a jam before where I wasn't very, I undercut the front. It was like super heavy.
And then you're always playing catch up, right?
Yeah. And it can make it challenging. So make sure you're accurate with your draw reimbursement schedule. I think it's important.
I think that you just hit it too. My third one would be find a solid operator from the building or contracting side. Yes. If it's not in-house, right, you're not on deal number 1,000, whatever you're on, like you got to find a good operator from the contract. It's probably the biggest risk.
It'll make or break you.
It'll make or break.
Yes.
That's right.
Yeah. I've got 2 main general contractors I've worked with. Brian for about 13 years, Mike for 11 and a half years. They've each done hundreds of houses for me, right?
Yeah.
And people say, well, how do you have such good contractor relationships? I can't get a guy to stick around for more than 5 jobs. So it's super easy. One, they're good people, and I'm good people.
Yeah.
Right. If 2 people are good people and they're honest,
yep,
you can overcome a lot.
That's right.
And 2 is I do what I'm saying I'm going to do. And I make sure they do what they say they're going to do, right? So, what does that look like? For the draw reimbursement schedule with the contractor is different than the one. It's not a reimbursement; like I'm fronting them some money, right? So at the beginning of a contractor relationship, I front less money. As a relationship goes on, like the first draw is 25 grand. Right, but I trust him. Like Mike or Brian, if I had to go on vacation for a week and I leave my wallet with somebody, I could leave it with them and I wouldn't worry at all because they're super trustworthy guys. That said, I still keep holding them to the draw schedule.
Sure,
if they put in for a draw schedule and X, Y, and Z have to be complete. I'm like, and my weekly construction meeting rolls around. And I'm like, they put in for 30 grand. I look at the 50 pictures on the screen. I look at the briefing. I'm like, that don't add up. Hey, Mike, why are we requesting 30 grand? It's like, well, I swapped out. I did the roof, but didn't do the others.
Right.
Okay, cool.
Makes sense.
30 grand, right?
Yeah.
It's like, well, sometimes I get the answer from another guy's like, I put it in, thought maybe I wasn't sure. I was like, dude, like, are you in a jam and need some money? If so, I'll do it. If you're just like being whatever, then I'm not going to pass it. It's like, I don't need the money. It's like, talk to me next week.
Yeah.
So I think
trust ultimately. I mean, that's huge.
It's huge.
The fact that you trust. I mean, that's
it's
got to be number one.
Yes.
Yeah.
I trust, but I also make sure our incentives are always aligned. Right, they're incentivized to finish the job.
Right way.
Right. Yeah. I think another, like, I'll just walk you through. We talked about construction. Here's how I used to manage my construction. So go back 10, 11 years ago, my wife and I first started doing fix and flips together, right? Brian would call, hey, I think I'm ready for my next draw. And like, oh, okay, drop what I do, run over there, and bring the checkbook. How much do you need? Like,
wow,
that was my construction management process, right?
Yeah.
And then I got really smart. I hired this guy named Sean, and Sean would get those phone calls, and like I'd sign a check. Like, well, ask Brian how much. I'd fill it out to the contractor, and only give it to him if he's ready. Well, guess what? Sean doesn't want to tell the contractor you can't have the check. So, of course, the contractor was always ready for it.
Always ready.
And so he would drop what he would do. So I was like, this is so stupid. And like, we got to do this once a week. And so now my construction process is this.
Yeah.
I have one guy, Paul, has been with me for, I think, 11 years.
Wow.
He's been my employee, or started off as a sub, now he's an employee for the last several years.
Yeah.
Great guy. He does my real estate photography. He does my borough check inspections. Does my punch lists when a project is done right before listing.
Yep.
Make sure the buyer's report inspection work is done. And he also does the weekly update photos of the jobs. So my construction process is Lauren, my construction admin, says, hey, Paul, here's the list of houses you need to go to on Monday and Tuesday. He goes, takes 50 to 100 pictures of every job, sends them to Lauren, put it on Dropbox. And I found myself a long time ago asking the same question week in and week out, like the same 10 questions for every house.
Yeah.
Like, who's the contractor? Is it a fix and flip? What's the address? What's the contract price? How much in overages so far? How much have we paid so far? What's left? What were the extras? What's required for this week's draws? Like, that's about all I need to know. And so it's like, instead of asking the same questions,
Yeah.
now she answers those questions ahead of time on a one-page briefing sheet.
That's awesome.
Right. So I
Yeah.
look at the pictures, the briefing sheet, I look at, and it makes I can manage my construction in 1 to 3 hours a week.
Wow.
Yeah.
And that's how you scale.
Yeah. Yeah.
Jim, you're the man. I appreciate it.
Appreciate you guys,
Looking
man.
forward to a big 2026 together, brother.
Likewise.
Appreciate it, man. Thanks for coming on.
You bet.